We can't declare victory yet. The great inflation isn't over until the Fed says it is.
Our expectation is that inflation will be conquered over time. It's not going to happen immediately.
The notion that this is inherently an inflationary economy is not obvious to me.
The Fed can't relax at this point on the inflationary front, even though, from the credit front, it probably should be a little softer.
Financial conditions have tightened to some extent, but it's really in the banking sector that we have seen most of the tightening.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a fantastic week, full of brilliant conversations, live from Washington, D.C. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and on radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Counting you down to retail sales in about 30 minutes from now. We'll recap some of the data for you. Yesterday, jobless claims a little bit higher than anticipated. PPI, factory gate inflation a little bit softer than anticipated. Breathing some life into the bullish view on the equity market. Equity futures this morning just a touch negative off the back of bank earnings. And I have to say, bank earnings so far, so good. JP Morgan out of the gate, getting Q1 off to a great start. The stock is up by almost 6% in the pre-market. Lisa, Citi out just moments ago.
Yeah, beating pretty much across the board. But we're looking at the FIC sales and trading, fixed income currencies and commodities, coming in at almost $4.5 billion versus an estimate of $4 billion. $1.3 trillion of deposits. We will get the comparisons year over year in just a minute. But you're seeing that extension of the gain in Citi shares as once again, the big banks are the port in the storm, as you said, and we are seeing them consolidate their power. And that perhaps is what we're the story of the morning.
If you looked at these names, would you know we had a banking crisis in the last month?
No. No.
Do you have a clue looking at Q1, looking at the guidance from JP Morgan?
They're going to do everything they can to just underplay this, and they're going to play homage to the banking crisis happening with smaller bank America. I want to say, John, as a rule of thumb, and our next guest understands this, with Citigroup, you move the decimal to the left because they did a 10-to-1 reverse stock split when they were flat on their back 15 years ago. Citigroup is not JP Morgan. Citigroup is not Bank of America. Citigroup is not even UBS. They are a bank in restructuring mode right now, and it's great to see those numbers.
The stock is up by more than 3% in the pre-market. Here's a headline for you, Lisa. Jane Fraser, the CEO of Citigroup. Markets saw the third best quarter in the last decade in fixed income.
Yeah, that's exactly what I was watching. And I'm thinking to myself, of course, you take a look at the volatility that we've seen with rates hopping all over the place, and you see all of the potential dislocations. This is when banks do the best. This is when you've got market makers that actually end up making bank. And that's what we saw with Citigroup. But that, to me, highlights the dissonance between credit crisis discussions and what the banks are doing with their balance sheets.
There's an extra level of detail we need, but looking at the early moves of Citigroup, the early move fades just a little bit. JP Morgan is still up by more than 5%. You've had a beat from JP Morgan, a raise as well for the rest of the year. You had a beat from Wells Fargo. It's on to next week, Morgan Stanley, Goldman Sachs on deck. Equity futures right now just about unchanged on the S&P 500. The guide through the next 30 minutes or so, your next stop for this market, US retail sales, and we're looking for a pretty soft retail sales print with a 10-year at the moment up just a single basis point. The 10-year 345.62. We get lucky through the next hour. I'm pleased to say that alongside us here at the global headquarters of the International Monetary Fund in Washington, D.C., Mohammed Al-Arian, Bloomberg opinion columnist and Queen's College Cambridge president. Mohammed, good morning.
Good morning. Can we stop calling it a banking crisis? This was not a banking crisis.
Tell me why this wasn't a banking crisis.
A banking crisis is a crisis of the banking system. This was a banking tremor. A few banks that were caught offside and badly supervised went down. The big banks are just fine, and we're seeing that. In fact, the big banks are benefiting from this because they've got two things. Not only are they viewed as safe, but they've got diversified business models. And you saw what happened to FIC. You saw that suddenly it is the narrow bank that are riskies, and it's the universal banks that are resilient.
If it wasn't a crisis, why do you think that officials needed to use the systemic risk exception?
I think it crept up on them, and they just went a little bit too far. I understand why they did it. I suspect I would have done it too. Right?
Do you think they posed systemic risk?
I think the deposit run and the speed of the deposit run at First Republic scared them a lot. But this was a failure of supervision. We have to understand that this was a failure of supervision. We have enough evidence now to show the extent to which the Fed failed in the supervision of First Republic.
So let's say, absolutely, this is not a banking crisis. This didn't rise to some kind of 2008 or even, potentially that's a 1980s type scenario. But is it a credit crunch that we're going to see evolve?
Yeah, so we're going through a major transition which has made some business models incredibly stressed. And we're going to see that. We are now focusing on the banks. You just wait to see all the levered finance that has to refinance itself. We talked a little bit about commercial real estate, but it goes well beyond this. When you change the interest rate paradigm as quickly as we did, you will catch people off sides. And some people will be able to get back on side. Other people have business models that doesn't allow to get back on side. Now, why am I saying this? Because some of the smaller banks have that issue. They have higher funding costs, that deposits have become more flighty, and they're going to have to contract their loan books. And they are making loans that the big banks will not make. So yes, we are going to have a reduction in credit contraction.
We've got to talk about the Federal Reserve. Raghu Rajan, a good friend of yours, I know, was fantastic yesterday, and I wish we were alongside him. He was talking about some of the blame lying at the feet of the Federal Reserve and the unwillingness of this institution that we're sitting in this morning to call out monetary policy officials for their role in some of the instability. Where would you stand on that now, Mohammed?
So I think it's very important to keep our central banks accountable. They are very important. As you know, I'm a huge fan of central banks, and when I criticize the Fed, it really hurts me. But it's important to have some accountability in the system. Why? Because that is the basis of political independence. And no one wants to erode the political independence of central banks. But central banks have to own their mistakes and have to learn from their mistakes to continue to enjoy something that is very precious and very important for the system as a whole, which is the ability to make policy without having to go to Congress.
One Fed official this week, in the last week at least, said the move from 0 to close to 5% in about 12 months wasn't the problem with the banking system. You've talked about a failure of bank management. Do you think that has anything to do with it? A decade of zero interest rates and then going from 0 to 5 like that?
So we've had 3 stages of this tragedy. Stage 1 was too loose for too long. Remember, in March, when the inflation print was 7.5%, the Fed was still injecting liquidity into the economy. That's March of last year. We should have started tightening policy significantly a year ago. The second problem is that after this whole long period, the Fed mischaracterized inflation. So we lost 9 months of possible policy adjustments. When you start late, you end up going higher and staying there for longer. That is the logic. That is why timely policy responses are so important. So, of course, this interest rate cycle has been mishandled. Of course, it has had an impact on what we are seeing in terms of not only financial turbulence, but also what we're going to see in terms of economic turbulence.
At your Cambridge, there is a spectacular stained glass window of a Venn diagram. It is just a remarkable stained glass window. There are 42 circles here at the IMF, and they're trying to find a Venn diagram of politics, economics, debate that gets to a common theme. I can't find the common theme this time around. What is it?
So I was surprised when in the 6 o'clock hour, you said there's all these issues and there's no common theme. There's absolutely a common theme. And the common theme is a world of deficient aggregate supply. We have gone from a world of deficient aggregate demand, that was the story after the global financial crisis, to a world of deficient aggregate supply.
Right.
You get inflation, you get interest rate hikes, you get more inequality, both nationally and globally.
Right.
And I could go down the list. And if you under-respond, if you under-react to that shift, then you start triggering all sorts of issues.
Brilliant. But the heart of the matter is, and Ambrose Evans Pritchard absolutely nails this with a neo-Vixelian essay today in the Telegraph, the bottom line is there's too much money out there and not enough investable opportunities on a global basis. We've been this way for a while. Is it a generational issue where we're never going to escape this trap of just too much money chasing not enough constructive ideas?
So we certainly have too much money. What I would love to discuss with him is the notion that we don't have enough investment opportunities. We are going through major transition. The energy transition is a major investment opportunity. Let's talk about the market failures that mean that we haven't been able to take advantage of this important window in terms of investments. And we can have a long discussion about what the US has done, and I know it upsets the Europeans, but they're right. They're trying to address market failures in order to have more private-public partnerships to invest in an area that is critically underinvested in.
A brilliant idea. Can he run the Port Authority of New York?
Look,
You know, can Mohammed get us a tunnel?
Mohammed is raising a really, really important issue. This is not with the benefit of hindsight. We said it at the time. Germany and the European countries who had the luxury of incredibly, exceptionally low interest rates didn't make the move to invest in a way that they should have done.
Well, the way I would, in Davos, it's simple. There's all these fancy placards and marketing ideas of infrastructure and, you know, McKinsey-like 80-page documents on development, and it just hasn't happened.
Do you not remember when Wolfgang Schäuble left the German finance ministry and they all stood outside and did that black zero as if it was something to celebrate? It was a total failure of policy over the last 10 years.
Well, this is this word austerity, which really hasn't come up here.
And economic policy as well.
Are we going to see austerity in Britain again? I mean, within the shocks that we see now, Britain is so comfortable with austerity, aren't they?
No, unfortunately, Britain has become comfortable with low growth. That's the problem. You know, we have three issues, and with my friends, people you know very well, Michael Spence and Gordon Brown, we've been working on this for a while. We have three issues. One is we have inadequate growth models. We have to rethink how we grow. Two, we have inadequate domestic policy implementation. And three, we have inadequate global policy coordination. Those are the three big areas. Now, there are solutions to all three. That's the good news. But we've got to focus the discussion.
The good news is this conversation's not over. Mohammed's going to be speaking with us. Mohammed Al-Arian, live from the International Monetary Fund Global Headquarters. Coming up in the next hour, we'll catch up with Aaron Cannon, the CEO at Clear Harbor Asset Management. From Washington, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. is pressing the need for allies to coordinate against economic coercion, not just military threats. This as Japan prepares to host top diplomats from the Group of 7 nations amid heightened tensions with China. U.S. Ambassador to Tokyo, Rahm Emanuel, saying, quote, that coercion piece is important. China is set to be a key focus of discussions at that meeting. China's mega banks are planning at least 40 billion yuan of bond sales, kicking off a major funding push to comply with global capital rules by early 2025. Bloomberg has learned Industrial and Commercial Bank of China and its 3 closest rivals are planning to tap domestic debt markets to sell a new category of total loss-absorbing capacity bonds as soon as June. Bloomberg has learned that Mitsubishi UFJ Financial Group's wealthy clients lost more than $700 million on Credit Suisse Group's AG's riskiest bonds purchased through the Japanese bank's brokerage venture with Morgan Stanley. Japan's largest banking group is holding meetings of senior officials to look into the matter as it reaches out to roughly 1,500 clients who lost a combined $717 million. And Supreme Court Justice Clarence Thomas and relatives sold 3 Georgia properties that include Thomas's boyhood home to GOP megadonor Harlan Crow in 2014. That's according to a report. ProPublica says that Thomas didn't list the real estate sales on his financial disclosure forms that year or report his extensive travel financed by Crow that occurred over 2 decades. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the one thing that seems to be off the table in the discussions is the role monetary policy has played in creating financial fragility. And you have to believe that 3 crises in 2 decades, it has to have played some role. What about, for example, QE? Wasn't that part of what created the fragility that, in fact, we're seeing now? And that's why we need organizations like the IMF to start talking. They're very hesitant to complain about central banks of the industrial world because those guys have more economists than the IMF sometimes.
Can I just pick up on those comments from Raghu Rajan, the professor of the University of Chicago Booth School and former IMF chief economist, also led the Indian Central Bank as well. This line right here, on the lack of criticism of the Federal Reserve. They're very hesitant to complain about central banks of the industrial world because those guys have more economists than the IMF sometimes. Tom, what did you make of those comments from Raghu yesterday?
I think he's enjoying his independence where he's not a public official anymore. He was on fire, and let me explain why he gets cred. There were 4,300 books written on 2007, 8, 9. The short read, when I do college lectures, I go, shut up and read fault lines. And it's the concision. It's Mohammed knows this. Mohammed's game theory. Everybody's got a different act. Raghu is financial economics, which is algebraic concision. Think Loretta Mester on global steroids. Yep. That's what you're getting there.
We've got Ken Leon of CFRA standing by to weigh in on some of the financials. Just to wrap up Citi, Goldman and Wells Fargo, or rather Citi, JP Morgan and Wells Fargo this morning. We've also got Mohammed El-Erian alongside us this morning in the studio at the IMF headquarters. Mohammed, before we talk about the banks with Ken, I've got to get your response to Raghu Rajan. What did you make of that?
Of the criticism? Sure.
Or the lack of criticism of this Federal Reserve.
So historically, the IMF is very hesitant to, in any way, criticize the Federal Reserve, the ECB, but it finds it very easy to criticize central banks in developing countries.
Why?
Many reasons.
Can we touch on a couple of them?
Look at the voting power in this institution. Look at whose support you need to get these things through. I mean, it doesn't. I'm surprised you're surprised.
We're going to continue this discussion. We're going to go to Ken Leon here right now on the banks and get an update. He's Director of Equity Research at CFRA, but far more importantly, decades of experience and use of cash at these major banks. What's the future use of cash? I remember talking to Charles Peabody, Ken Leon, years ago, and he said this is what they're going to do with their dividend increase. With the revenue joy today, can you model out a 3 or 5 year persistent use of cash to advantage shareholders at these banks?
Well, obviously, they don't have control of their book because regulators have quite a bit to say about return of capital like dividends. But they're investing in technology. They're investing in artificial intelligence. They're also durable banks, which means that assets are flowing in, not out of the largest banks. And what we will see in the future is an environment where how do you really maximize profitability in a slower growth economy? Again, what we learned today from the large banks is that net interest income, the higher rates year over year, is astounding. But that will become a more challenging comp in the second half of this year. So the operating businesses need to perform and grow, to your question.
Ken, did we learn anything today about what we are going to hear from some of the smaller regional banks, especially given that PNC did come in better than expected? But again, these are the biggest of the small ones.
So our financial team at CFRA, we're looking at everything closely. But again, the smaller banks have really a different risk profile, as Mohammed mentioned, in terms of, flighty deposits. So the ability to be diversified and also have a business where they can continue to lend. I also like Mohammed's other point here is the smaller banks lend in areas the large banks don't, which is really commercial real estate or construction activity, or to small businesses. So they play a vital role in the U.S. economy, but it's a more tenuous position as a bank versus the largest ones that I cover.
Let's wrap it up, Ken. Ken Leon there of CFRA on the latest financial results there. Tom, do you want to weigh in just quickly?
I'm just going to weigh in with we're in denial going back to 1833 and Andrew Jackson about how you run a national banking system. The U.S. model is unique, cherished in this Washington, tested every 5, 10, maybe 15 years. We're in one of those tests right now. And there's one simple answer, as Gerard Cassidy talked about. We're going to come out at the margin with fewer banks.
Fewer banks.
Yeah, 4,000 down to 3,000.
Mohammed can talk to you about what's happens in the UK. If you go to some rural town in the United Kingdom right now, there are no banks. Maybe this truck pulls up, and quite literally, no exaggeration, you get this small truck that might pull up a couple of days a week. and people will come out and do their daily bank, and then the truck goes and disappears. We've seen closures across the country for years.
I know you want to get back to the Fed discussion with Mohammed, but let's address this. Is the Canadian model better than the U.S. model in banking? I mean, you sat on the chair at PIMCO where you had to deal with that kind of thing. Is a 5-bank model better than what we're doing here?
That's such a hard question. That is such a hard question.
We don't do it in the 6 o'clock hour. We do it in the 8 o'clock hour.
But even if it were a better model, we're not getting there. I think we're going to lose a few banks. But the bigger question, Tom and Lisa and John, is what happens to regulation? Because you may get a regulatory overreaction to what is happening.
That's what Spence would say.
Okay.
Well, I would say, Tom, the better question is, who for? Who's it for? You know, is Canada better? Who for? The banks,
yes,
Big Five?
That's fair.
Or is it for the individuals that have to bank? Because I'm sure there's many Brits who are listening to this right now and thinking, well, it's not good for me. If you live in a rural town and you can't go to the bank anymore, it's a frustration. It's not a good thing.
So I should tell you a story. When Silicon Valley Bank UK was taken over by HSBC, I was doing a panel in Cambridge, and there was a venture capitalist there. And there was a startup person there. And I said, tell us, what's your reaction? The startup person says, you know, I went to HSBC to get a loan. They rejected me. I then went to Silicon Valley Bank. They gave me the loan. Now I'm a client of HSBC. I don't know what's going to happen to me. And
that's brilliant. That's in the zeitgeist.
Mohammed, that's
Lisa,
such an important way of framing it. And Lisa, I think that's why some people were almost bemused that the individuals that I would say had some part of blowing up SVB, that was the bank that banked their community. And then they exacerbated the bank run in the way that they behaved. I will never understand that. I will never understand that. They looked smart because the bank collapsed and their money wasn't in the institution anymore, but ultimately they were screaming fire.
Which raises a question, especially when you started out and said this is not a banking crisis, this is a banking tremor, and you said this was something else. Do you think that the IMF has been too negative and taken this and basically run with it and said, you know, the actions of a couple bad actors can be extrapolated out to everyone, and oh my goodness, we're on the precipice of something major, when Janet Yellen of the Treasury is more right?
So I've been consistent on this from day one, even when Bloomberg Economics came out and said U.S. recession is 100% probability, that no, there's nothing certain about the U.S. recession. We can avoid it. I still think today we can avoid it. The probability has gone up. I'll give you that. But we can still avoid it. We only get there if we continue making mistakes. This economy is fundamentally sound. It's fundamentally sound. It's that we get in the way of it and we trip it up. I don't know if you saw the Economist cover this week.
I did, yeah.
But it's trying to explain, you know, why is the U.S. economy surprising on the upside, and what are the lessons to learn from that? And there's a lot of lessons to learn from that.
Do you believe in the theory that you should take the other side of the Economist cover? I'm thinking of Brazilian covers in years gone by. I mean, anything to that?
That was the reaction I got when I put it up on Twitter.
Yeah.
Right?
I'm sure it was. The magazine cover, you've seen that? I think it's a tall horse, isn't it?
Good.
Yeah. The U.S. economy riding high.
Riding high.
The heart of this, within the econobabble, I'm going to call it 3 ratios with 6 opportunities, and we devolve it down to this thing, productivity.
Correct.
And at the heart of the matter is every conversation we have, and in morning TV we don't talk much about it, but the fact is you get to productivity.
Absolutely right.
You know,
absolutely. We haven't invested enough in people. We haven't invested enough in other things that enable growth and enable productivity. That is unfortunately the big mistake we made for the last 20 years.
Retail sales coming up in about 5 minutes' time to build on some of the data we've had so far this week. Jobless
claims. Is Mohammed going to tear it apart for us?
Jobless claims yesterday a little bit higher than anticipated. PPI, factory gate inflation, a little bit softer. I have to say, economists on Wall Street looking for a pretty negative print on retail sales. We'll catch up with Ethan Harris of Bank of America, and we'll get the Mohammed view on the US economy and what the Fed would call the totality of the data. What is the totality of the data?
Totality.
From Washington, this is Bloomberg. Retail sales data, just seconds away, 20 seconds away to be precise. Going into it, equity futures on the S&P 500 totally unchanged. In the equity market, on a single name basis, JP Morgan flying after beating first quarter estimates and raising their guidance for net interest income as well. That gives the financial sector a lift this morning. JP Morgan up by 5.8%, Wells with a beat up by 4%, Citi up by 2.3%. Getting some data, some retail sales. We were looking for a soft print. You get an even softer print. Here's Mike McKee.
Yeah, it looks like Americans stayed home, and some of those warnings we got from the credit card companies are coming true. Retail sales headline down 1%. That compares with a 0.4 decline the month before. And then retail sales ex-auto down 0.8, and that is compared with a 0.1 drop the month before. Now, the control group, which is what economists watch, down 0.3. That was down from the 0.5% gain the month prior. So all in all, it is not a particularly good report on in the retail sales numbers. We knew autos were bad, and now the rest of it looks bad too as well. Quickly giving you the import price index down 0.6, and ex-petroleum down 0.6. So some good news on the inflation front, but not good news on the consumption front. I'll let you check the markets. Let's see what we can find out about where the spending was during the month of March.
Hey, Mike, we'll come back to you in a moment. Stay close. Your equity market basically unchanged on the S&P 500 to slightly negative, even with those better-than-expected numbers out of the financial sector. In the bond market, yields a bit higher by 5 basis points. Lisa itching to explain this one on the 2-year, north of 4%. On a 10-year right now, Bramo, up 3 basis points to 3.48.
This makes sense to me. If I look through these numbers, my knee-jerk reaction is how much is just because gas prices were lower? Because right now you're seeing retail sales, ex-auto and gas, down by 0.3% versus the estimate drop of 0.6%. Are we just simply seeing the nominal effects of gasoline prices dropping in the face of a potential decline in the economy?
Yields up, Tom. 6 basis points at the front end, back 3.4.
Yeah, yields are up. Michael McKee, if you're still there, when I look at retail sales, I get out the calendar. How does this retail sales rapidly adjust a view of Q1 GDP?
Well, we'll get an update of the Atlanta Fed GDP Now tracker in a couple of hours based on this this data. And what's interesting is that a lot of people have thought the first quarter was better than anticipated. You remember Jamie Dimon this morning said consumer spending held up. But Lisa has a good point about gasoline and the nominal price. Gasoline sales down by 5.5% during the month. So there is certainly a price impact there. Food prices down. I'm looking here. Food and beverage stores down 0.1, so not so bad there. Where else did we see some movement? Clothing stores down 1.7%. You always have to be careful with the Easter effect around this time of year. And general merchandise stores down 3%. Department stores down 2.5%. So there are some negatives in there, but a lot of this may have to do with falling energy prices as well.
Mike, it's a good point. Mike McKee there on the latest retail sales. Take a second bite at this, Lisa. I think the point that you made just moments ago is really tremendously important. At first look, you've got that headline which delivers a miss. You look to the market and then you see yields higher on a 2-year by 6 basis points. Not a major move in the context of what we've seen at the front end of the curve over the last month, but still higher by 6 basis points, north of 4%. Just go through it for everyone, piece by piece.
Okay, so basically you've got the headline number, a drop of 1% versus the expectation of 0.5%. But then if you take a look at the piece-by-piece components, you strip out autos, you strip out gas, and it's only a decline of 0.3% versus the expectation of 0.6%. This is why people are taking a look at this and saying it's not nearly as weak as perhaps some people had previously expected. How long, when we played narrative roulette, we had what? The no landing, then we had the hard, the soft landing, then the hard landing, and where are we now? Are we back to soft landing, or are we back to the Fed having to go back to 6%? How long before we get back there?
I think we still have to wait and see what happens after the, can I call it a banking shock of the last month?
Tremor.
Tremor? Not a crisis. Okay.
Tremor.
My hand's in correction mode this morning, so I'm going to call it, I'm going to be really precise and careful with my words. After the banking tremor of the last month, we still have to wait and see just to what extent financial conditions are going to tighten. I think that speaks to a new approach from the Federal Reserve, who have implied one more interest rate hike, then stop at 5.1%. they're not going to be in a rush to deviate away from their guidance they delivered just a couple of weeks ago, Tom.
This is a joy of Bloomberg Surveillance with Mohammed El-Arian and John. Now to bring in Ethan Harris, head of global economics at Bank of America Global Research, and seriously a student of our Federal Reserve System. Ethan, a broad and open question on a Friday. You and Bank of America will adjust to this economic data. What is your theme on the American economy you'll focus in your Friday and weekend writing for Monday morning?
Well, I agree with the commentary here. The number, if you look at the control measure, which goes into our GDP estimates, was actually slightly better than expected. The rest of the report was very consistent with what our own card data was telling us in terms of both the overall weakness of the number and the sectors that were weak. I think we need to be a little careful here. I mean, we started the year off with pretty solid data. Now we're getting a payback into March. And so the question is this the beginning of that slide into recession? I'm leaning in that direction. I think that there's some weakening, fundamental weakening going in the economy. Some of it, of course, was gas prices, which are not really relevant here. But there is some fundamental weakening. And this is before the stress in the banking system. I'm not sure what we're supposed to call it. The kerfunkel in the banking system occurred. And
there we
haven't
go.
seen that kerfunkel. That's the new name. And so we haven't seen the impact on lending. So I do think that the economy will slide into a mild recession some point in the third quarter.
I've got to ask the obvious question. You have access, many would say, to the greatest amount of knowledge on the American banking system that Brian Moynihan and your team have developed. When you talk to the banking bankers, the retail bankers, the commercial bankers at Bank of America, how does that inform your economic analysis?
I mean, we talk to all the businesses. We look a lot at our proprietary data, which particularly on the card data is quite useful for predicting things. You know, I mean, it's way too early to talk about exactly how big the shock is to bank lending from the recent kerfunkel. But you know, and we really need to probably should be focused mainly on the regional and smaller banks. We're just gonna have to wait and see. I don't think that Bank of America is necessarily the right place to look for where the tightening is gonna come from.
Kerfunkel. Mohammed, does that work for you?
I can't pronounce it, so I'm not sure I can. Ethan, I'm really curious. Why is it that the Fed staff agrees with you, but the top Fed leadership pushes back against you in terms of slipping into recession?
I think it's politically incorrect for the Fed to come out and say, hey, you know what? We were too late hiking and we allowed inflation to spin out of control. And oh, by the way, we're going to fix it by creating a mild recession. I think it's very hard for them to make that statement in this political environment. So what they've done instead is they talk about, well, first the staff is forecasting a mild recession. And they talk about downside risks. They talk about the landing zone, you know, shrinking, getting ever smaller. It's now kind of the size of a postage stamp. And I think that they just don't want to fully acknowledge that actually this time around the recession is going to be mainly a central bank story. And I heard your earlier comment about the economy being in fundamental health, and I 100% agree with that. The problem is that aggregate demand is too high. As you noted earlier, aggregate supply is not doing that great. Something's got to rebalance here, and it's the Fed rate hikes cooling the economy off.
So let me ask you a little bit more on this. So we now have a difference between Fed staff and Fed leadership. We also have a difference between forward policy guidance that has been reiterated over and over again and where the market thinks the rates are going to go. How long can we live with these differences?
Well, I think they'll get resolved when the Fed shows that, let's say that we do slide into a recession in the third quarter. If the Fed basically sticks to their current narrative, which is we're going to be on hold through the end of the year, the bond market's going to have to adjust to reality. I think the problem with the bond market right now is it's used to looking at recent business cycles where the Fed cut very quickly in the face of recessions. In fact, the Fed cut before recent recessions. But this is different. This is a mini version of the 1980s where the Fed didn't back off from tight monetary policy for a long time because they were trying to get inflation under control. And they'd rather do it with a extended period of weakness, perhaps a mild recession as we're forecasting, followed by a weak recovery, and kind of chip away at the inflation problem, then just hammer the economy and create a major recession. So I think the bond market is wrong. I think the Fed is going to do basically what they're saying in their projections.
Ethan, wonderful to catch up with you. Ethan Harris there of Bank of America, and great call on looking for that softer retail sales print. Ethan Harris there of Bank of America Global Research. Aren't you sick of this? We talked about this on Friday. Mohammed starts to wanker, taking our jobs.
Well,
you know,
there's a value add. You know, I mean, all in all, I mean, what I love about Mohammed is he can go English football and American football.
Just like that.
That's a rare gift.
I know.
Honestly, there was a real statement in that question. I wanted to know your response. That was quite a question. You know, how long can this go on? So what's the answer? How long can this dissonance in the Fed go on?
So I think Ethan's absolutely right. I think what's going to happen is the Fed's going to impose its view, and that comes with a bit of risk to the economy. But I think that's what's going to happen. Their credibility is so low that I don't think they can risk another shock to their credibility.
You think the market comes up to the Federal Reserve again? That's how we reconcile this gap?
The market is more likely to come up to the Federal Reserve than the Federal Reserve go all the way down to the market.
Interesting.
What's fascinating here, and you and I remember this, the Bank of Japan got it wrong, what seems now a long time ago. Is all of this theory infected by that single mistake that the BOJ made, I'm going to guess in 2003? They lifted rates. Oops, we got to come back down. Is there an uncertainty because they don't want to be embarrassed?
So I think there's certainly that, and they'll also cite the ECB, right, coming out of the global financial crisis. So they certainly don't want to be embarrassed again. Yeah. They've been embarrassed several times. You know, we've had the insider trading allegations. We've had the inflation miscall. Right. We've had, I mean, so there's been a series, and we now have evidence that under this Fed, volatility during the market volatility during the press conferences is 3 times as high as it was for previous Feds.
That's because of McKee's question.
I just say Chairman Powell's doing a great job. That was the annual review from Mohammed there. Just top job at the top of the Federal Reserve. Just fantastic. Mohammed's going to stick with us.
What were you listening to?
Erica Nigerian's going to join us in the next hour. Looking forward to this conversation with the equity research analyst over at UBS to talk about the big bank earnings. And the big bank earnings, so far, so good. Equity futures negative. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. government is struggling to explain how a 21-year-old man in a junior post was in a position to allegedly leak a massive trove of classified U.S. documents related to the Ukraine conflict. Jack Teixeira, a cyber specialist for the U.S. Air Force National Guard, was arrested in Massachusetts and is scheduled to be arraigned in U.S. District Court in Boston today. The New York Times reports he was the leader of a gaming chat group where the documents first appeared. In a testy public exchange with her Chinese counterpart today, Germany's foreign minister said Taiwan's destabilization would be a, quote, horror scenario, and any change in Taiwan's status would be unacceptable. Beijing has ramped up military drills around Taiwan in recent months. Meanwhile, China warned about the risk of falling debris near Taiwan this weekend following a planned satellite launch, denying Taipei's claims that a no-fly zone will be imposed to the north of the island. A setback for Boeing just as it ramps up production of the model that's a major cash cow for the company. The U.S. manufacturer is pausing deliveries of some 737 MAX jets to address a production issue on the rear end of some aircraft. Shares fell as much as 5.3% after Boeing said it expects deliveries to decline in the near term as it expects those affected jets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Our forecasts are significantly better than the IMF forecast. But what I should say is that last year we were the fastest growing economy in the G7. We are very confident about the UK's medium and longer term prospects.
What Jeremy Hunter would recognize is that we've actually had a substantial upgrade for UK for this year. It's just that we haven't gone as high as maybe some of the other forecasts are. But we've actually seen things turn out better than expected in the UK.
That was us mediating here at Bloomberg, a conversation with Keene, the IMF First Deputy Managing Director, and Jeremy Hunt, the UK Chancellor of the Exchequer, speaking to Maria Tadao earlier this week.
The Chancellor of the Exchequer is a gifted guy. I mean, he did the London Olympics, no small matter. Probably he's doing the coronation as well. Can he solve the Tottenham problems?
What would you like him to solve?
There's a few of them. I mean, I reviewed the Tots yesterday.
You'd like him to run your transfer?
Find a coach, find a soccer head, which I guess they just brought in here as well. Jeremy Hunt is a really interesting guy. He's a different Secretary of the Treasury, a different Chancellor of the Exchequer.
Hopefully we can catch up with him next time. There's some really interesting moves in this market this morning, and good morning to you. JP Morgan numbers came out a little bit earlier, way better than expected, raising their guidance as well. That stock is up in the pre-market, but yields are flying now by 15 basis points. I talked about a really tight range for the two-year Treasury. Maybe I spoke too soon. We're back to 4.1% on a two-year yield, higher by 14 basis points. And Lisa, as you've pointed out a few times already in the last 30 minutes, look at retail sales once, look at it twice, and strip out energy.
That's been kind of all of the data. And this, to me, is this going to be the big story, the head fake that was energy prices going down that causes a feeling of disinflation that was faster than it was? We also have these headlines from Fed Governor Chris Waller coming out and saying that he actually favors monetary policy tightening more consistently and that the rates are going to have to remain higher for longer because the progress on the core, again, this goes to sort of stripping out the more volatile segments, has not been good enough, which really goes to what Mohammed was saying. Where do we see some reconciliation? Does the bond market come up to the Fed, or does the Fed go down to the bond market?
And Mike McKee, you've been working through some of those headlines from Waller this morning, from Governor Waller. What do you see, Mike? And good morning.
Good morning, John. Well, a fairly hawkish speech from Christopher Waller today. He's noting that inflation did come down a little bit in the CPI, but it didn't impress him. He thinks that it's still way too high, and he notes that the Fed has raised rates to dampen aggregate demand, but consumers and businesses are showing remarkable resilience. And he said this growth would mean that so far tighter monetary policy and credit conditions are not doing much to restrain aggregate demand. He says there's more work to do. Rates will have to go higher and, as Lisa pointed out, stay there for longer. It almost sounds as if he is saying we could go more than once at this point, and that may be what's helping contribute to the two-year yield rising the way it is this morning, because he's certainly on the hawkish side. Austin Goolsbee on CNBC, he is a voter this year, the Chicago Fed president, saying we still have to address inflation and get it down, although he sounds a little bit less hawkish. He's been the most dovish out there lately, saying that there has been progress made. But right now it looks like Governor Waller is leading the hawk parade.
Mike, thanks for that. Mike McKee on the latest Fed speak off the back of the latest data in the United States. And here's the latest move in the bond market, up 14 basis points.
Two-year yield?
On a two-year, 4.11% on a two-year yield this morning, Tom.
It's fascinating. We've got the right guy to talk about this. Mohammed El-Arian really out front on suggesting that we needed quarters ago some form of interest rate regime that Mr. Waller's still trying to catch up to. Your comments, please, on a really informed generalist in economics saying that we just got to keep it going.
So when you have a 5.6% core inflation rate and it's not coming down, you have an inflation problem. Yes, headline came down to 5.1, but core is what people really look at.
Mm-hmm.
I think what we're going to find out, and here let me put myself, is over the next 3 months, the debate over whether we slip into recession or not slip into recession is going to fade relative to the debate as to how does the system adjust to higher for longer. And that's going to be the key issues. And for the marketplace, it's going to be technicals dominating fundamentals, because there's going to be real question marks as to some of the business models, the viability of some of the business models.
One of the bombshells underreported is the former Vice Chairman Richard Clarida in The Economist magazine saying we're not going to get back to 2%. Something in the vicinity of it. This is a debate. You and I are going to be on a panel here in a number of hours with just a set of wonderfully esteemed people. And the core debate is this magical R-start. I love what AEP says about it. He calls it the neutral Goldilocks.
Right.
Where is the neutral Goldilocks?
So I am in the camp, it's higher than what it has been in the past. The key issue is not whether we ultimately bring down inflation, is at what cost do we bring down inflation to the economy and to financial stability. That's the key issue.
We're talking about the Fed trying to regain its credibility. And we heard from Chris Waller, a hawkish tone. We're seeing a little bit of a pop in a two-year yield. It still is far below their expectations. We're still pricing in almost 100 basis points of rate cuts. How can the Fed regain that with actions without taking rates to, say, 5.5% or 6%?
So when you have a problem of analysis, of forecast, of communication and actions, you lose control of the two-year yield. The two-year yield is not supposed to be doing what it's doing. I don't think we quite appreciate what it means to have that sort of volatility at the front end of the curve. It makes cash management really complicated. We're not supposed to, the two-year yield is supposed to be anchored to a large extent by the Fed. And if you see what it's done, over the last 6 weeks, we've had a high of 5.08 and a low of 3.58.
That's insane.
It is insane. These sorts of moves today, that's insane as well. That shouldn't happen. And that complicates cash management. The minute you complicate cash management, you start creating all sorts of things. So look at the technicals of the markets, because I think that they're going to be really important for the next few months.
Well, you've said a few times that the Federal Reserve has gone from being a source of stability to a source of volatility. It speaks to the moves you're talking about. Mohammed, we've got a few minutes left with you. We're at the heart of the International Monetary Fund. It's an institution that I know is close to your heart. You're no longer part of the IMF, though, and you're speaking a little bit more openly about the failure of institutions over the last several years. How do you make a room like this, a little bit later, the good and the great are going to sit on that stage and have a conversation moderated by the same establishment journalists we've heard from a million times, including Tom Keene? And they're going to ask the same questions we've all heard a million times. And they're going to come out with the same answers we've all heard a million times. How do we finally break the groupthink of events like this, conferences like this one, like the World Economic Forum in Davos, Switzerland? How do we change this stuff? Because ultimately, we all sit around with the happy talk and we end up with these decisions that cause these volatility. How do we change this?
By making a huge effort to have more cognitive diversity. And it starts at the Fed. I've been on record saying the Fed should pursue the Bank of England approach of having two external, independent members of the FOMC. The ECB is lucky because the ECB gets a range of views because of its construct. The Bank of England has the confidence of bringing in external members. It's not always easy, but it contributes to cognitive diversity. The Fed has not. And therefore, you get groupthink. I think you have to start at the core of the system. These meetings, the real discussions happen not on stage.
Behind closed doors.
But happen behind closed door. And I think there is a different tone of discussions behind closed door than there is on stage.
I would suggest, John, with the media that we have today and now the new immediacy of the media, you get back to Ruchir Sharma's The Rescue Culture, where all of these well-meaning public officials don't want to be the one to create pain. Can we do it pain-free? There's a bank with a marketing scheme wrapped around a banking wrapper out near SFO. Can the big banks step in and pony up $30 gazillion so there's no pain?
But Tom, to the point of rescue culture, and I hear what you say, who got wiped out in the last month or so? Investors got wiped out.
Investors took $700 million just to one of the Japanese banks.
We're talking about the failure of regulatory oversight, the failure of monetary policy over the last 12 months. Who lost their job?
Well, yeah. I mean, yes.
Truly, where is the accountability of the people that attend an event like this? There is none.
Yeah,
none
I mean, we're going to run out.
Chairman Powell failed on inflation and got a second term.
He did. We are in a point where you have to ask who's going to be harmed. For example, Mohammed, very simply here, the Swiss outrage over 3 banks in Switzerland becoming 1 bank in Switzerland over 20 years. And that, the Swiss people, are they the losers?
I think the big losers are the people who are less fortunate to begin with.
Yeah.
Inequality of income, wealth, and opportunity is what suffers in a world like this.
Mohammed, well said. And thank you for being so generous with your time.
Well, thank you.
Fantastic as always. Thank you, sir. Mohammed El-Arian. Counting you down to the opening bell. Equity futures slightly negative. Yields a whole lot higher in the bond market. Eric Nielsen of UniCredit joining us from the IMF in the next hour.
We can't declare victory yet. The great inflation isn't over until the Fed says it is.
Our expectation is that inflation will be conquered over time. It's not going to happen immediately.
The notion that this is inherently an inflationary economy is not obvious to me.
Fed can't relax at this point on the inflationary front, even though, from the credit front, it probably should be a little softer.
Financial conditions have tightened to some extent, but it's really in the banking sector that we have seen most of the tightening.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Closing out the last day of our coverage from Washington, D.C. for our audience worldwide. Good morning, good morning. From the IMF's global headquarters in the nation's capital, this is Bloomberg Surveillance, an extended edition, 1 extra hour TK. Tom Keene, Lisa Abramowicz and Jonathan Ferro. Equity futures right now on the S&P negative, about 1/10 or 0.2%. A little bit earlier in the last hour, 30 minutes ago, we had some retail sales which lit a fuse underneath two-year yields, and Governor Waller laid it on thick. Some hawkish Fed speak, Lisa, just moments ago.
Yeah, basically saying that we have to raise rates further and potentially keep them there for longer. Again, reiterating a tone that we've heard from John Williams of the New York Fed, perhaps not among some of the other areas, including Goolsbee. What could they do to get the market to believe them? Because, yes, we're seeing two-year yields pop, but not all that much considering where they want them to go.
A little north of 4%. We were at 4.1% moments ago. So that's the bond market, the data the Fed speak out with. Tom, earlier on this morning, before that, numbers from JP Morgan. Let's pause. Q1 starting in a pretty phenomenal way relative to expectations for the major banks, with JP Morgan beating on the first quarter, Tom, and delivering a raise to their guidance. And I think the raise to the guidance was the unexpected piece of all of this.
The summary of the two is to meld it together. We talked to Dr. O'Larian about the complexities of productivity. Michael Rosenberg at Bloomberg years ago, and John, within 14 days, the study he did was so important, the IMF picked it up. It's the Bloomberg Financial Conditions Index. And moments ago, it went from a negative statistic over the zero line to a positive. That's not what Jay Powell wants. It is signaling a trend of accommodation within the system, and part of that is the excellence of JP Morgan and other banks, but it's moving away from the published and visible restriction that these central banks desire.
I think we have to be super careful, very careful about drawing too many conclusions too soon about what's going on in the financial system based on the earnings of these major players. Lisa, there are some indications, some people are drawing conclusions already, that these major banks have benefited in a massive way from the, what are we calling it, the tremor of the last
the banking
month?
tremor.
No crisis anymore. The banking tremor, kerfunkel, whatever. OK, I'll pick another word. Of the last month. They're taking in deposits when other people are losing deposits. I think we still want a bigger flavour, a better flavour, a sense of what's happening in the regionals. I'm not sure PNC is quite the right indicator for that a little bit earlier.
Smaller companies account for the majority of the employment in this country, and smaller companies disproportionately rely on regional banks in order for their credit. We are seeing a view of the biggest banks and the biggest companies and their lending impulse, which is strong, and we know this. The question is the gains that we have seen, is the strength in some of these big banks coming at the expense of smaller ones, or is it a good read on what's potentially benefiting all financial players? We just don't know yet, and I think that really is the question.
The good news is that things have calmed down. If you look at the recent indicators around the kind of numbers coming out of the Federal Reserve at the moment for the banking system, things are a little bit more stable. I think stable was the word that PNC went with a little bit earlier this morning. But we can conclude, and Mohammed even went as far as saying, yes, he won't call the last month a crisis, but ultimately this should lead to some kind of tightening of lending standards and should be hurting growth further down the road.
No one is suggesting that's not the case. My question is, are you going to see a divergence with the big banks consolidating their power at the top and their strength, not indicative at all of some of the weakness that will come with that credit contraction?
One of the themes, and a theme of the panel I'm going to be doing here in 90 minutes, and this is mostly from Olivier Blanchard, is there's things we can't see. Jerome Powell can't see them. Our esteemed guest can't see them. Peter Bookvar highlights this with some moldy retail sales. Online sales were flat, but still up 14% year over year. And I would suggest the mystery for everyone at these meetings and in the banks, including JP Morgan, is the technological overlay. Each and every day, what technology is doing to us, business and government.
Tom, it's also the inequality between large and small in the banking system and the wealth inequality in society as well. You know what I'm about to talk about. LVMH and Hermes those numbers that we've seen from the luxury players off the back of China reopening have just been absolutely phenomenal.
And reading the first reports from Bloomberg Intelligence, what to me is absolutely stunning is Hermes says these dynamics weren't because of China travel. This is an interior recovery by China wrapped around the Chinese New Year. John, I know you celebrate it extensively, but the bottom line is in the Chinese New Year, you got to go buy a new scarf. That's what it comes down to. This was an interior success for LVMH, not about the travel that we saw
you hand
in
out money
2019.
Chinese New Year. Isn't that what you do?
Evidently, you buy Hermes scarves.
But you hand it anyway.
Yeah, you do.
Okay.
In red envelopes.
Yes.
And
For
then you...
Thank you, Lisa.
Yes.
For Lagarde, I've got one on today.
What's that?
This is an Hermes
red
bow tie.
Oh, is it? Okay.
Yes. It's you know.
Very on brand. Okay. Aaron Cannon with us now, CEO of Clear Harbor Asset Management. Lisa, pull it together.
Thank you.
Aaron, thanks for being with us.
Never says that to me.
Talk to me about the numbers we got a little bit earlier, the data specifically, and then we'll turn to the earnings. What are you taking away from retail sales and what we heard from Governor Waller just in the last 30 minutes or so?
Sure. You know, I think the retail sales data, you know, I think Lisa probably hit the nail on the head. There was a lot of sort of energy woven into that. And so take that with a grain of salt. But if you look at this sort of broader schematic over the last week or two, the data has certainly deteriorated, whether it's the PMI data on the manufacturing side that we saw hit 46.3 a week ago Monday, or, you know, whether it was the railroad car data that we've been looking at. There's plenty of reason to be cautious here on the economic front. Economic activity has certainly been on the weaker side. As it pertains to Waller and Al and Mr. Goolsbee out in Chicago, you know, clearly the last thing the Fed wants to do is suggest that their work is done when it may not yet be done. They may be in the 8th inning and the market thinks they're in the bottom of the 9th, but they only have another rate hike or two to go. And I think that's the sort of challenge of the Fed at the moment, to maintain legitimacy around fighting inflation, even though inflation pressures are coming down too. You look at CPI, the last 9 months of CPI on an annualized basis is only 3.25%. The prior 6 months through June 2022 was 10%. Inflation trends are moving in the right direction. And the Fed knows that, but they don't want to call the all clear signal yet.
Aaron, do you feel like you have a clearer sense of what the banking scenario really is after getting the earnings of JP Morgan, Wells Fargo, and Citigroup?
Well, I think the narrative has probably been correct this morning, which is we're looking at mega banks and the mega regional and PNC, and we're trying to deduce tea leaves out of what happens in a week or two from now when we start to see the regional banks report. I do think there's going to be a huge bifurcation in regional bank earnings. We're going to see several dozen banks maybe appear a little more stressed than the vast majority of the banking system within the regional banks, right? So you have still huge levels of diversification within regional banks, and you have most deposits that are insured. And so I think that's the good news out of the regional banks. The bad news is deposit flight. You saw that accrue here on the margin in earnings this morning. Now, deposits are still down, and why is that? It's because, well, if you look at, if you have a wealth management account at JP Morgan, you're not probably putting your cash in deposits, you're putting them in T-bills, and so that natural outflow has occurred. I think Wells Fargo had deposits drop about 7% year over year. So we're going to see a tale of two stories within regional banks in a week or two, and a tale of two stories within the mega center and the regional banks.
Aaron, you've got a wonderful fixed income heritage, and I think of your Yale University, where basically the endowment taught us that you got to be in the market to find success. We've all got an Ibbotson tattoo on our left arm. What I want to know, Aaron, is what's the enthusiasm right now for equity markets? I don't see much enthusiasm out there in greater America for owning stocks. Am I right on that?
Well, Tommy, you point something out very importantly, which is that the market has been climbing this wall of worry. And, whether it's here or in Europe, I mean, gosh, think about 3 months ago, waltzing into the new year and thinking European equities would be outperforming U.S. equities. Well, energy prices have, on the margin, collapsed in Europe, which has allowed for industrial titans to not just survive, but now on the margin flourish again. But speaking to fundamentals, this is a point of caution for me. If you look at the equity risk premium today, it's at about 190 basis points. If we are entering a light to moderate recession, usually that would peak out over 400 basis points. You look at consensus around earnings for the S&P 500 at, let's say, $219. That's 19 times the multiples just before the market opened this morning. And so, certainly not cheap. Well above 25-year averages, and certainly not multiples you see during a recession. So I think the concluding thought is that if you think we're entering a recession, the current market dynamic within equities would seem to be overpriced. If you think we're going to avoid one, well, maybe we're closer to fair value.
And that's the judgment call. Aaron, thank you, sir. Aaron Cannon there of Clear Harbor, framing it up for everybody. Take your pick, pick your poison. Right now in the equity market, just a bit softer on the S&P 500 earlier on. That move sticks down 0.2%. Standout move this morning, though. Yields higher, Lisa, by 10 basis points, a little north of 4% on a 2-year. On a 10-year, up 5 to, let's call it 350.
Consumers stripping out energy costs look better than expected in terms of, or not as bad as expected. And all things being equal, basically, the market is caught between a hot rock and a hard place with respect to these earnings from the banks. If they do well, does that mean there's ongoing strength in the economy? And then does the Fed have to hike further?
Stuck between JP Morgan and Governor Waller, I'd say, this morning.
Yes.
Governor Waller sounded pretty hawkish. Dinah Ramowa joining us very shortly from Kirkoswald. Looking forward to that conversation in just a moment. Live from Washington for our audience worldwide, with equity futures down just a little bit, counting it down to the opening bell about 20 minutes away in New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Chinese leader Xi Jinping met visiting Brazilian President Luiz Inácio Lula da Silva today in Beijing. On the trip, which comes a little more than a month after Lula visited Joe Biden in the U.S., shows the importance given by the leftist leader to both countries. Now, his visit to Huawei facility on Thursday sent a message that he won't pick sides in the U.S. fight against the Chinese tech giant. While the fate of mifepristone, also known as the abortion pill, plays out in U.S. courts, healthcare providers have another drug they can use. Misoprostol is primarily an ulcer medication, but it's also used in conjunction with mifepristone in 98% of all reported medication abortions in the U.S. It can also be used on its own, and multiple healthcare providers say they'd subscribe it if mifepristone disappears from the market. Dozens of advocacy organizations and children's safety experts are calling on Meta to terminate its plans to allow minors into its new virtual reality world. Meta is planning to invite teenagers and young adults to join its metaverse app, Horizon Worlds, in the coming months. But some argue that young people could face harassment and privacy violations in the virtual reality app, which is only in its early stages. And OPEC Plus production cuts are likely to drive up oil prices and inflict more pain on consumers already squeezed by high inflation. That's according to the International Energy Agency. It says global oil markets will tighten more than previously expected, forcing heavy inventory withdrawals of about 2 million barrels a day on average in the second half of the year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We've had 3 stages of this tragedy. Stage 1 was too loose for too long. We should have started tightening policy significantly a year ago. The second problem is that after this whole long period, the Fed mischaracterized inflation. When you start late, you end up going higher and staying there for longer. That is the logic. So of course, this interest rate cycle has been mishandled. Of course, it has had an impact on what we are seeing in terms of not only financial turbulence, but also what we're going to see in terms of economic turbulence.
Just the brilliant Mohammed Al-Arian there of Bloomberg Opinion and of Queen's College, Cambridge. What's the joke, Lisa? Something like, other than that, how was the play, Mrs. Lincoln?
Yes, exactly.
Something like that. I was just thinking
about
listening to Mohammed talking about the economy and the Federal Reserve.
Exactly. So, they got communication wrong. They got how long they waited for raising rates, et cetera, et cetera. So this is really the issue. Why are we not hearing more of that here? And we continue to talk about that. And I thought that you really highlighted that well. That really should be the question coming out of this, because that's where the focus is, the volatility in developed markets.
For a long, long time, Tom, institutions like this one at the International Monetary Fund, and Mohammed was talking about this, very open, very critical of policymakers in emerging markets. Yet when it comes to DM, the Federal Reserve, and the monetary policy failures of officials, policymakers across developed markets, we've heard very little from these institutions.
There is the Red Book, Stanley Fischer, after the crisis of 1998. Everyone at gunpoint had to read it years ago, and it's precisely what Dr. Fischer talked about, is that the pressure of appeasing the people writing the check for these institutions is so tangible that on a day, I don't think our audience understands how the boats floated here by a select number of countries, including 1600 Pennsylvania Street, which is like 4 blocks. So, John, you go to the Hay Adams.
Yeah.
You look out across Lafayette Park.
Done that with you.
Beautiful vista.
Wonderful.
Yes.
Look, Mohammed talked about it. Ethan Harris did as well, of Bank of America. Tom, how reliable then is the outlook from an institution like this one? How reliable is the outlook from the Federal Reserve? When Ethan Harris, in the last hour of Bank of America, you and Mohammed, Lisa, you asked the right question too. Why is there this difference between what the Fed staff are projecting and what Fed officials are communicating? And Ethan Harris said, basically, it came down to one thing, politics. He said it came down to politics.
That's always true. I think the criticism is just, apt, but at the same time, it's an institution that has to fold together lots of different opinions and piece them into an aggregate one view from about 150 different views. Right now, Diana Moa with us, with Kirkoswald, and we're going to jump into the EM market debate. Diana, I love your note, and you go into a little bit of portfolio theory there, where you talk about the shift of alpha and beta and EM right now. The fancy CFA types understand alpha and beta, but what is this sea change for your emerging markets?
So there's a couple of things that are happening. From a top-down perspective, I think the conversations we're having are pretty interesting, where you look at what's happening in the US, policymakers are still grappling to see where they are in terms of growth, inflation, etc. In EM, we started hiking rates well before the Fed hiked. So 13 out of 20 of the major emerging market economies had hiked before the Fed were even starting to move their monetary policy. So that's one part. So the conversations, the big sea change from an EM perspective is now we're asking policymakers, when are you going to start cutting rates? Because inflation appears to have peaked in a huge number of emerging market economies, and real rates are actually rising up. So that, for us, is a big sea change.
A focus today is the debt external, dollar-denominated debt, and also debt internal. What is the fiscal stance of the EM economies you look at right now? How fragile is it?
It's very dispersed. You have some emerging market economies that do have fiscal space that can still spend to keep growth going, particularly in parts of Asia, where they actually did not do as much fiscal spending as we saw in the the developed markets and in EMEA and LATAM. So there is room there from a fiscal perspective, but it's very dispersed. I think where we see vulnerabilities is in the low-income countries. And that's the discussions we've been having this week in the IMF. What kind of support can the MDBs provide some of these low-income countries, given they're still struggling with the impacts of the events of the last 2 years, and they have limited fiscal space?
There's a traditional thought in investing that during some sort of recession, particularly in the U.S. is still a better place to be than, say, the developing world or in Europe or outside of the U.S. Is this time different because of some of these policy divergences with the developing world, frankly, getting out ahead before the developed nations?
100%. I wouldn't say it's necessarily different, but I think the issues coming from DM are much more pronounced this time than we've seen in previous cycles. Whether we're looking at what we saw with the regional banks, that was a very US-specific issue, US and Europe to an extent, whereas EM was much more insulated from that. And, looking forward, discussions around the debt ceiling, that's going to be another, pretty volatile period. So is Treasuries really a safe haven in that sort of environment? I think you look at quality duration outside the US to diversify your portfolio.
Do you feel this sort of gravitational force away from the dollar and away from dollar-denominated debt in a way that you really haven't before?
Not necessarily away from dollar-denominated debt. I think from an EM perspective, one of the most interesting things that are coming out of the discussions in the IMF is there's more of a push for local, when you're talking about restructuring, local debt restructuring is coming into play as well. So it means in the past where you think in a restructuring it's going to be the dollar-denominated debt, this time both the local and the dollar are coming to play. So for us, we don't necessarily see a shift away, but it certainly adds burden to the low-income countries.
Diana, you just said something moments ago that I think is so important. We're sometimes asked what's the biggest difference between DM debt and EM debt, and I have a very simple cheat guide for that. When things get bad in EM, you run, and when things get bad in DM, you buy the debt of those countries. You just said something interesting. Are we going to change the way we behave towards the Treasury market if we have another debt ceiling debacle later this year? Or do we just reach for the old playbook and buy the debt of the countries that are doing bad things?
So it's going to be a pretty interesting summer. That's my view, because I think if we're, it's one of the data points that came out in a discussion here was there's something like a 30% probability that you may be talking about potential technical default in the US come the summer, right?
3-0?
Yeah. So that was in one of the panel discussions in the IMF. So that's a pretty high number when you think about it. Do you really want to be buying debt when we're having conversations on, who's going to be paying that bill? Can the government actually get a consensus to pay back investors? I'm not necessarily sure that's the play. So I still think, going forward, how investors think about fixed income will have to evolve. There is a lot of high-quality duration outside DM US rates that is actually paying you to get into the trade, and inflation is falling, so you have both the safety, but the duration rally that's probably going to be imminent.
We've got 60 seconds and we can do this. Let's say I'm a PM, I'm running a fund, I've got a pool of assets that are meant to have some kind of risk mitigation characteristics. Typically, it would be treasuries. You're saying I need to diversify. What to? JGBs, bunds, where am I going for that?
I would go for something like Mexican debt.
Outside,
outside the US. So there's some sensitivity to US growth. And if the Fed is forced to cut rates, the Bank of Mexico is not going to be so far behind. And maybe something in Asia. So those would be my two.
Do you hedge the Mexican peso? I'm sort of thunderstruck in an amateur way of 21, 22 out to an 18 peso. Do you prosecute that unhedged or hedged?
I mean, the last 18 months, if you'd been hedging the peso, that would have been a terrible decision. I mean, look at that. Performance,
look, I bought the Australian 97 year at the wrong time as well. But this is, this is really important, and this is a complexity to this about what you do with foreign exchange while you play in the AMOA space.
I think you keep the foreign exchange. EMFX, you look broadly speaking, depending on where you're looking at, currencies are up anywhere from 3 to 8% year to date, EM currencies. Again, it's this diversifying view of we already took the pain of currency depreciation. We have high real rates. It's attracting flows back into the markets. You have remittances still looking strong in somewhere like Mexico. So,
John, this is gospel. What she said, I learned this the hard way.
This is one of the most thought-provoking conversations we've had.
I absolutely agree.
Diana, thank you.
Thank you.
Diana Ramoa there of Kirkus World. You've got a lot to say, haven't you?
I'm just wondering, do you buy currencies and debt of the different poles, of China, of the US, like buy everybody and make sure that, if there's tensions, you're hedged.
Where's the policy risk right now?
Exactly.
Where do you want to be? Erica Nigerian of UBS on the big bank earnings this morning. Up next. What a busy morning of price action for you. First it was the big banks, then it was the data, then it was the hawkish Fed speak going into the opening bell. 15, 20 seconds away. Equity futures still negative by a couple of tenths of 1% on the S&P 500. On the Nasdaq 100 was soft and negative down lower by 0.5 of 1%. There's the opening bell in New York. Switch out the board and get to the bond market. Surprise, surprise. We had some stability for 5 minutes and then the yields broke out. On a 10-year by 4 or 5 basis points. Let's call it 350 on 10s. On a 2-year up 10 basis points. Your yield higher to north of 4%. Let's call this 4.07% on a 2-year yield. The dollar making a bit of a comeback. Euro dollar 110.26, negative 0.2%. Euro dollar earlier on this morning, a new high for 2023 on that currency pair. Looking out to crude, WTI still north of 80, 82.74, positive by 0.7% on WTI crude. About 35 seconds into the session, equities just about negative on the S&P 500, down 0.1% on the S&P. On the Nasdaq, down 1/3%. But check out the banks. Nothing negative about what we heard from JP Morgan a little bit earlier this morning. We had numbers from them, Wells Fargo and Citi, to kick off earnings season in the United States. Shanali Basak has more. Hey, Shanali.
John, we have to start here with JP Morgan because not only did they bring in a record amount of revenue and raise what they expect in net interest income this year, they're also pouring water on your idea of a credit crunch. You have the CFO telling analysts on the call that they're not aggressively tightening standards all across the board. With that said, you did hear Jamie Dimon draw some words of caution here. This idea that 2024 in particular has such little visibility. When you look at what's happening in the supplements as well, you see charge-offs starting to tick up. You see that 90-day delinquencies, for example, in credit cards also starting to tick higher. But the corporate lingo here is normalization. So you're not hearing broad concerns right now. You see it in the stock price movement, of course. You both had Citigroup, PNC, Wells Fargo, all really meeting or beating expectations on all the main lines of business you could think of. We have seen the investment banks until this time trade better than you saw the consumer banks. So you're seeing the consumer banks start to get a little bit of that lift. Remember, coming into today, PNC in particular, John, had been one of the worst performers in the KBW Bank Index. So a little bit of love to start off the regional bank earnings system as well.
Shanali Basak, thank you so much. And on to Monday as well, and continued bank earnings. Right now, folks, and this is important, Global Wall Street leaned forward for the concision at UBS of Erica Najarian. To say she's equity research analyst barely describes the detail of the notes. There's others on the street doing the same thing, but she's doing it with a shocking clarity as well. I want to understand, we talk here at the IMF, Erica, about fiscal space. What is the space for capital appreciation of these major banks? Not the price target per se, but do you see them with a 1, 3, 5-year upside, or is the there now?
So look, this is essentially what JP Morgan showed us today. If you're a strong bank, and there will be weaker banks as we think about the rest of earnings season. If you're a strong bank, you could withstand what's coming. Look, what Jamie said, we don't know where rates are going. The recession is probably a strong probability from here. However, you could still protect your returns if you have strong earnings power, right? And I think those kinds of banks, to answer your question directly, could have upside as the market pays premium for that earnings power, but not just that earnings power, that earnings resilience, even in an unpredictable rate market and even in a recession.
As you study the major banks, and I want to take it down to another bank you cover, and Mr. Wilmers was so kind to me, M&T Bank of Buffalo. Are there a lot of mid-sized JP Morgans out there? Are there a lot of banks run like a Swiss watch, like M&T?
So there are a lot of banks that are extraordinarily well run. And I would say that the regional banks that I cover that are 100 billion in assets or more have to be well run because of the regulatory scrutiny that they withstand every single day. So yes, I mean, the compliment of having another regional bank, Jamie Dimon, is rare. And I would say Renee Jones is probably in that category at M&T. But let me say that a lot of regional banks are extraordinarily well run.
Within that is the idea of combination. Is that the next year? I've got a phrase, and I'm not talking about banks, but the zombie roll-up of the great zombie roll-up of 2023. Even if they're not zombies, are the banks going to be forced to merge?
So I think at the end of the day, the near-term outlook for consolidation is not a very friendly one, right? You have a lot of, potential marks on the balance sheet that you're buying because interest rates are much higher than what, was booked on the bank balance sheets. But I think over the medium term, given some of the pressures that are impacting smaller regional banks, I do see regular way consolidation picking up, but I don't see that as a near-term catalyst.
Erica, we're in Washington, D.C., and we're here for the IMF meetings, and it's very political, and you feel all the politics kind of injected into conversation. So I look at J.P. Morgan results, and I think, if I were in Washington, why wouldn't I say, all right, fork over some of that cash, and we can bail out the smaller banks as they come up needing help? And you know what? These big ones have plenty to spare.
Look, I mean, at the end of the day, right, the large money center banks have already stepped up. You know that they were leading the consortium of depositors for First Republic, for example, right? And I think at the end of the day, JP Morgan actually mentioned the upcoming special assessment that could come from the FDIC. The big banks are proving that even with very high capital standards, high liquidity standards, they can earn a pretty significant return. So I don't necessarily know what that means for, future regulation, but at the end of the day, they're showing, pretty strong resilience, and that might be, something that, perks up the attention in Washington for sure.
Well, this is sort of the regulatory risk overhang, and this is sort of what I hear is the biggest comment. The only kind of skepticism around just buying the big banks and not the small banks is sort of increasing divergence is the regulatory overhang. But do you just lean in and you say, look, JP Morgan, Citigroup, Bank of America, they're all, I mean, we'll see with Bank of America, but they're all delivering incredible results. Just buy those shares. They are undervalued, but ignore the regionals because they still could come under a lot of pressure?
Look, I mean, our ratings distribution essentially just summarized what you just said, Lisa, because I think at the end of the day, the rate of change in the regulatory construct is probably going to be wider for the regional banks than it is for the big banks, right? The big banks, in terms of the regulatory standards, are already extraordinarily tight. And while we have Basel IV coming, the CET1 or Common Equity Tier 1 capital prints that Wells Fargo, JP Morgan have put up in the first quarter essentially says they have the earnings power to build that capital organically. And unfortunately, the regional banks are a little bit behind, right? PNC, for example, was at 9.2% CET1. And I think the capital floors for the regional banks are going to go higher. And I would suspect the market is going to expect that they need to be at 10.5%. So yes, I think the big banks at their current valuations and earnings power look pretty appealing here.
Erica, just one final question from us. There is some data that comes out in early May. It's the Senior Loan Officer Opinion Survey. There's a lot of people in this market who are going to be fixated on that when it comes out. Can you take anything away from this morning and make a suggestion as to what we might see, or rather might not see, when that comes out in early May?
Yes. So belt tightening is natural, right? Belt tightening is a natural result of tighter monetary policy as funding costs go up and as the probability of recession increases. However, the Senior Loan Officer Survey in May, I'm sure, will show that belt tightening. But I think the severity of the credit crunch, there's a lot of doomsayers in the market right now, is going to be perhaps undermined.
Interesting. Erica, thanks for that. It's wonderful to catch up with you. Busy day next week as well. Busy few days next week with the bank earnings coming in. Erica Najarian there of UBS on some of the banks, and hopefully we can catch up with Erica again in the next couple of weeks. This echoes something we heard from Jamie Dimon of JP Morgan. Now, Sonali did a fantastic job of not just breaking down the earnings report, but also going through the commentary from the C-suite. The CEO over at JP Morgan saying this: I wouldn't use the word credit crunch if I were you. Echoes of Mohammed in the last hour. No banking crisis. Don't use the word credit crunch. The CFO of JP Morgan goes on to say, we're not running around aggressively tightening standards right now. So, Torsten Slok of Apollo, credit crunch has started. Remember that headline? We read it a few times over the last week. Jamie Dimon, I wouldn't use the word credit crunch if I were you.
And the word dispersion that we heard from Erica Najarian, it's going to be just the crunch or whatever you want to call it. It's like two Americas. It's going to be dispersed across 5 Americas of American banking. There are going to be losers out there, but are they, to borrow the Turkish lira phrase, idiosyncratic, or is it a broader system? Certainly Ms. Najarian made clear she doesn't buy the gloom.
Well, there's a credit crunch. It just depends where you look. In Silicon Valley, there's clearly a credit crunch. For startups and venture capital, there's a credit crunch. For commercial real estate, there's a credit crunch, and possibly worse. In the mortgage market, well, there's kind of a question. We've seen some tightening with respect to auto lending. So in specific sectors, there are definite restrictions in lending, areas that aren't as significant for some of these big banks. So they are not necessarily capturing the stress that we're seeing in other segments of the economy. It's really just whether it's going to have a broader effect or not.
Just to recap some of the market action in the early part of the session, about 10 minutes in this Friday morning. Good morning to you. The equity market positive by 1/10% on the S&P 500.
We're positive?
On the Nasdaq, we're negative by 1/10%. A lot of attention on the banks for good reason. JP Morgan numbers look pretty brilliant relative to expectations and relative to the banking tremor of the last month.
Thank you. Very well said.
Anytime. In the bond market, yields look a little something like this, with a focus on the front end of the yield curve this morning. Your 2-year yield in America, Treasury yields higher by 11 basis points, north of 4%, 4.08%. We're focusing on the banks for good reason. Got to talk about the data as well. Retail sales look softer at first look. As Lisa, you mentioned a few times, on a second look, strip out energy, not as bad. Then you fold into the mix Governor Waller with some pretty hawkish headlines going into the opening bell.
Potentially looking to raise rates further and hold them there. Guys, we're not cutting again and again and again. That's what the Fed keeps saying.
On repeat.
On repeat.
On repeat. Coming up, as we round out and wrap up our coverage here in Washington, D.C. at the IMF World Bank Spring Meetings, Eric Nielsen, Chief Economic Advisor at UniCredit, joining us around a table. Looking forward to that from Washington, D.C. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Some of Ukraine's European allies are increasingly skeptical its military will be able to make a decisive breakthrough this year. Kyiv's allies are reportedly reining in their expectations and considering the need for intense fighting well into 2024. U.S. officials were offering their own downbeat assessment of the outlook 6 to 8 weeks ago, according to a collection of classified documents whose exposure in a leak has stirred anger in Kyiv. Meanwhile, the U.S. government is struggling to explain how a 21-year-old man in a junior post was in a position to allegedly leak those documents. Jack Teixeira, a cyber specialist for the U.S. National Air Force Guard, was arrested in Massachusetts and is scheduled to be arraigned in the U.S. District Court in Boston today. Some trouble for Supreme Court Justice Clarence Thomas. According to a report, Thomas and relatives sold 3 Georgia properties that include his boyhood home to GOP megadonor Harlan Crow in 2014. ProPublica says that Thomas didn't list the real estate sales in his financial disclosure forms that year or report his extensive travel financed by Crow that occurred over 2 decades. And Bloomberg has learned that Mitsubishi UFJ Financial Group's wealthy clients lost more than $700 million on Credit Suisse Group's AG's riskiest bonds that were purchased through the Japanese bank's brokerage venture with Morgan Stanley. Japan's largest banking group is holding meetings of senior officials to look into the matter as it reaches out to roughly 1,500 clients who lost a combined $717 million. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Growth in the world is not going to go back to the 3.8% it used to be, but more 3%.
Certainly evidence in the data of some contraction in lending and some tightening of lending standards.
The crisis is coming upon us. A solution is needed. Something has to happen. Everyone's going to have to give and compromise.
I think the one thing that seems to be off the table in the discussions is the role monetary policy has played in creating financial fragility.
It's important to have some accountability in the system. Why? Because that is the basis of political independence. And no one wants to erode the political independence of central banks. But central banks have to own their mistakes.
Just a fantastic lineup of guests through the week here in Washington, D.C. at the IMF World Bank Spring Meetings, live from the nation's capital this morning. Good morning to you all. TK, what a week so far. And just to round it out, for you, what was the standout?
To me, for the standout is an absolutely original meeting. I said that, I believe, in 08, 09. I remember Jackson Hole, looking down the ramp there, you know, and it was a pleasant day. It wasn't 32 degrees like last year. I'm at Jackson Hole, and I'm looking down, and Stanley Fischer's on the phone, and he's animated. And, you know, that's usually not Dr. Fischer. Same thing here. There's some animated people hiding that they're animated.
To me, it's like walking into a room with a couple that you know is having real problems. And
really?
They're not.
And please, would you like to expand on this?
I like that. Right, open this one up. Let's go.
Hold on a second. It's like walking in, and you can feel these tensions, but it's clear they don't talk about it, and they all talk on the same platitudes. But it's clearly there's like tension under that they're not ever getting to.
Are you describing the dynamic around this table?
Let's move on. No, I really am talking about
on a serious point. The United States and Europe, there is some clear tension in global trade. I think that this week, the International Monetary Fund and the World Bank has totally failed to address it. It is the elephant in the room between the Europeans and the US. You speak to representatives of the European Union, and they don't want to talk about it. You bring up the comments from Emmanuel Macron over the weekend. They want to pretend they were never made. We spoke to the Commissioner. You just got this impression publicly that there's nothing to see here. But we all know there's tons to see here. There is tons to see.
And nobody mentioned the word China. Let's try to move on. Welcome at this late moment in Washington to Therapy with Bramo. We're really thrilled to have you. We have the advantage, as John and I try to do at Davos or at Jackson Hole, to finish strong with a qualified individual. Eric Nielsen carried the optimism of Europe at UniCredit in the darkest days of a number of years ago. He joins us today with the perspective of his public service at the IMF on the Turkey and Russia watch as well. You were in the trenches years ago of IMF duties. Is the IMF focused right now on fixing these debt crises, or are they completely distracted by the therapy that Lisa was talking about moments ago?
They feel distracted. I share the sentiment you said. I have been to probably 50 of these meetings over the years. And I cannot recall such a division between what the IMF writes about, what they talk about, what the official sector talk about, and then you go out of this building and meet in the private rooms with private investors and other private sector people, and they all talk about Russia, China, and then to Europe, right? Sorry, US, China, and the war, and then Europe. Here we talk about we need to do some fiscal retrenchment, we need some monetary tightening, inflation a little bit too high. And then we were lucky, we had a financial mini crisis, so we can talk about financial stability, but it's not really a problem, as we can have heard, and I agree. But that's what they talk about. They don't talk about the elephant in the room, that fundamentally economic policy of 30 years is out the window. We are no longer having free trade. We no longer have beliefs in free capital movements. We now are talking about industrial policies, sanctions, but they're not leading the discussion here.
And this institution was meant to be the very embodiment of that push.
That's right.
So what's gone wrong?
That's a good question. Let's first recognize that they're in a difficult spot. They have shareholders on both sides of the debate, right? But and they don't have a history of having criticized the US and China. You can't find it in the back, right? That doesn't happen. And these are the two big issues, right? And they don't really talk about it, right? This is they need to be brave. They should have been brave. They were not here. I think they missed their opportunity.
Tom talked about this repeatedly through the week. Tom, you brought it up so many times. The absence of China just hasn't
the absence
come
of
up.
China here, and long ago and far away, the managing director told me on her trip they at least began to engage discussion. And the word they use, which you have lived, Dr. Nielsen, is technicalities.
Yeah.
Is this going to be a process forward of technicalities, or is it going to be real leadership by Secretary Yellen, the managing director, by the Chancellor of the Exchequer, and indeed by the leadership in Beijing?
This is I don't know the answer how they would do it, but they're not there now, right? It is there are two good chapters from the IMF on sort of geopolitics, right? There's one in the WEO and one in the Financial Stability Report. They are about the effect on foreign direct investment this could have and estimate what it is. There's no policy conclusions. There's no sort of economic effect conclusions of it. So it's technicalities. Economic sort of analysis, interesting,
Lisa,
great start.
I totally agree with this.
Well, so is this basically a crisis of leadership?
Yeah, I mean, ultimately, yeah. I mean, maybe, but it's possible that the deck of cards handed here is unplayable because it's America and China, right? But I mean, yeah.
But what's the consequence then? I mean, honestly, what is the relevance then of the IMF if you have a situation where they're not taking a policy stance, they're not calling people out, they're not creating a vigorous debate at the beginning?
They're calling out the UK.
All right, okay.
That's what's, you know, and a lot of people in the UK, for obvious reasons, are very upset by it. Now, I think, Eric, we can sit here and agree that some of the policy issues of the UK quite rightly needed to be criticised over the last 10 years, and we can find some common ground there. But why are they so comfortable going after the United Kingdom? And then when Chair Powell walks around here, it's like, don't say anything, you know, it's fine. There was no failure there. You know, we can't talk about that. What is that about?
Yeah, it's about power, right? And who you want to please, right? It's and they haven't, at least at this stage, been willing to step up. And back in the Latin American debt crisis, De La Rozier today, still in his high 90s, would tell you stories about how he walked down the street to the Treasury and according to him at least, worked with them and made things happen. We don't quite see this now, I think.
So what's the consequence?
Well, the easy consequence is that this institution and the World Bank will be on the back seat and not in the driver's seat, if they even will be in the car, right? This is the issue, right? The world has moved on in a very dramatic way. I think the 30 years of globalization, where economic policy was set by sort of the ideas that we economists believe in, free trade and these sort of things, that's not there anymore. It's the security apparatus or agencies who have taken over. And maybe that's real life, and that's just what it is. But the result of that is that economic policy is not in the driver's seat anymore. And this is just not talking about it.
Let me dovetail. Gore gave a week ago with a stunning 5-year view with some of the zeitgeist this morning. And that would be a study of nominal GDP. You are the optimist, but can you frame out a reduced real GDP along with a reduced inflation?
Yeah, you can. I mean, this is sort of an economics argument that is based on the base case. And when I talked to a staffer here, and he defended what they've done, is that in the publication is that you have fundamentally to articulate a base case. The problem is that there are so many risks around it that one of them is bound to happen. But I think the problem is bigger still, because I think the whole narrative of economic policy making and who runs the show today has changed, or is changing. It's changed now, and this is not. So then we can talk about the growth. Maybe global growth is going to be 2.8 or 2.7%, and maybe the neutral rate. Yeah, it's going to come down a little bit, and the central bankers don't like it, right? And they kind of think, oh, now we're going to tighten monetary policy. That's a sideshow. It's a sideshow. It's not the real story in the real world. The clients we talk to, European corporates, other corporates, are like, this is not what they talk about. Inflation is coming down, and yes, we can discuss whether it's 25 basis points, one or twice, or whatever. Yeah. That's not the real story.
Can I get to the most important question of the morning? What was better, the $8 stracciatella in Washington, D.C., or the €3 stracciatella back in Milan? Which one?
It was very good, the one I had yesterday, I have to say, but most of it landed on the sidewalk.
Have you not seen that tweet? It's a great tweet from Eric earlier this week. He said this: greetings from the IMF spring meetings in DC, $8 for a stracciatella ice cream, which is almost as good as the one you get in Milan. What went wrong? Did the Fed allow US inflation to run away? Then raising questions about euro-dollar. Eric, this was great.
Thank you. Great way to end this. Thank you.
Great way to end the programme here. Tom, things don't end for you. A fantastic panel coming up a little bit later.
I think we're going to have coverage of it. This is a world-class panel, including Ella Arian, Olivier Blanchard, Gopinath of the IMF, but very importantly, grizzled and experienced voices of Korea and Argentina as well.
Thank you to the guests and thank you to the team for putting on this wonderful production here in Washington, D.C. This is Bloomberg.